Hello, my name is Ryan Conrad, and today I'm going to be giving a presentation about interest rates, why the Federal Reserve changes interest rates, how they change interest rates, as well as I'm going to apply those theories to the tech sector of the economy. So, to start, the Federal Reserve changes interest rates through the Federal Open Market Committee, is the most important monetary tool they use to change rates. And the rate they are changing is the federal funds rate. The federal funds rate is the rate banks use to charge one another for overnight loans. The banks use this rate to meet the Federal Reserve requirement at the end of each night. If they loan out too much money that day, and at the end of the day, they need to meet their Federal Reserve requirement, they will get an overnight loan from another bank, and that overnight loan is interest at the federal funds rate, which is set by the Federal Reserve. So there's a few ways they come up with this rate. First, they change this rate by buying back or selling U.S. government treasury securities. So, quick side note, this is the actual Federal Open Market Committee on my presentation right now. This is how a snapshot of what one of their meetings might look like. So, when they want to lower the federal funds rate, they will buy back more treasury securities. In turn, that puts more free money out into the economy. More money in the economy lowers interest rates. If they want to raise interest rates, they will sell treasury securities. By selling the treasury securities, they are putting more loans out there, which means there's less available credit in the economy, which in turn raises the federal funds rate. Before I get into how the tech sector is affected by these interest rates, I will first go over a brief history and explain why the Federal Reserve shoots for a certain interest rate over others. So right here is a graph of the United States history of federal funds rate. So as you can see here, in 1980, the United States from about 1980 was the peak interest rate. This was the high. It was 20.08% federal funds rate, which is the highest it has ever been. So that started because in the late 1970s in the United States, we had extremely high inflation, which devalued the dollar significantly. So the head of the Federal Reserve at the time needed to strengthen the dollar. So he did so by raising interest rates through the roof. And this was an extremely unpopular thing to do during this time. It was a very hard time for America financially and economically, very slow economic times. Volcker kept the interest rates high, as you can see here, for about 78 to about all the way through the 80s up until about 1990. So what he did there for that decade by keeping interest rates high, he successfully beat inflation, brought the dollar back to strength, and set up an extremely successful economic stage under Greenspan in the 1990s, where our economy flourished in interest rates, as you can see, except for a slight rise from 94 to 96. Interest rates downtrended significantly up to about 2004, when they were below 2%, about 1% in 2004. As you can see, they went up a little bit again in 08, and then when the economy crashed in 08 due to the Great Recession, interest rates hit an all-time low of 0.25%. They did this after the Great Recession to stimulate the economy. Without keeping interest rates low, we would have stayed in a terrible place economically. So what the Federal Reserve did is, by having low interest rates, they promoted spending, investing, for more free money in the economy, and that brought strength back to the U.S. dollar, as well as investments domestically. So, with a little bit of history in mind, the two biggest reasons the Federal Reserve will change interest rates is the supply and demand of credit as well as inflation. So, after the '08 crisis, we have kept interest rates historically low for the last 10 years, as I said, to promote spending. So, as of now, they have decided to start gradually increasing interest rates. This is due to less debt than we had in '08. Also, employers are hiring in large numbers again, adding more working class people back into the economy, lowering our unemployment rate. We also have beat the recession, and economic times are looking pretty good. So they are going ahead and raising the interest rate gradually. Our current federal funds rate is 1.5%, and that is still extremely low when you look at the history. So who benefits off high interest rates? That would be the commercial banking, particularly. They are striving right now due to the corporate tax cuts as well as the higher interest rates, because when interest rates go up, it costs them more money to loan out money. So in turn, they strike a higher interest rate for consumers who are looking to borrow. So they can even make a larger profit once interest rates start to rise. But that is just one example of a sector that will benefit from high interest rates. I will be discussing, in particular, the tech industry. So the tech industry is very not debt leveraged. They have very low debt. As you can see in this chart, Facebook, almost 0% debt to equity ratio. Google, about 3%. Intel, Apple, Microsoft starts going up. But when you look at the S&P 500 in general, you're looking at about 90% leveraged companies. And leverage is great for companies when you're doing really good. When business is good, the leverage helps you out. When business is bad, the leverage is tenfold worse than when times are good. So the tech industry being has a business risk of people moving on from one piece of technology to the next. As you know, technology can be very trendy in a way. And with that, people are quick to drop one piece of technology at the drop of a hat and move on to the new trend. So companies, especially tech industries, do not like to be heavily leveraged, because if they were leveraged and their business model started getting outdated or their profits turned south, they would stand at a position to lose a lot of money. So there is an exception, though, as Amazon is not listed on this chart, but Amazon has a unique advantage over a lot of tech companies. As you can see in this chart here, they are able to borrow at a 3.2% interest rate, which is better than China, Chile, Greece, Mexico, Russia. That's saying a lot. This is an example when they borrowed $16 billion to buy Whole Foods back in late 2017. They borrowed that money at a 3.2% interest rate. So this is a comparative. If all these other countries borrowed that same amount, this is what they could borrow it at. So regardless of where the Federal Reserve sets the federal funds rate and other treasury bond interest rates, Amazon's advantage is they're such a big, massive company right now in America, and they have such large cash flows. They have private investors that are willing to loan them the money at any rate negotiable. Whoever bids the lowest will get that interest rate. And that's a lot of money when you're talking $16 billion at 3.2% interest rate. So that gives Amazon a very good advantage over a lot of other tech companies. They're able to borrow money during high interest rate times and use that money to expand their business model, explore new frontiers, and make even more revenue with any money they invest into a sector or if they take on a new project. So on the other side of the spectrum, Netflix is another example of a tech company that is highly debt leveraged. As you can see, their free cash flow is negative right now, 1.22 billion negative, and it's steadily gone down negative since 2014. And this is due to Netflix's very intuitive business model. They have borrowed billions of dollars creating their own Netflix original content. This is very expensive to do, but it has turned out quite well for them as they have 60 million registered subscribers, which is an all-time high they reported in their last earnings report. So with them being heavily debt leveraged, the interest rates will affect them greater than a lot of other tech companies out there because their debt to equity ratio is 1.67, which means they're highly leveraged compared to the other companies. As you saw, Google has a 0.03 leverage ratio, Facebook 0.001 debt to equity ratio, Apple 0.87 debt to equity ratio for Apple. So if interest rates increase, Netflix will be at a position where it costs more money to borrow money. So they will have to either raise the rates for their subscribers. Us, the consumer, will see that trickle down to people who pay for Netflix, and they might have to pay more due to the interest rate spikes, as well as they might have to create less content if they can't afford to finance it at the higher interest rates. But with this in mind, since they are so heavily debt leveraged, to be successful, they will have to stay competitively advantaged. So other companies such as Disney is working on a streaming service don't take their market share because the leverage will severely affect them. So this can become a tricky task for a company like Netflix as interest rates climb. Overall, the tech industry looks very bright despite rising interest rates. This 1 year, they're up 32% since last year on the market capitalization overall. And as you can see on this graph here, 2000 was the tech boom. It slowly tapered off, and it continues to rise. Great Recession dinged it a little bit. But as you can see with the low interest rates, it has been climbing steadily. But even during the times of higher interest rates, from 03 to 08, interest rates were on the rise, and you can see that did not affect them at all when looking at history. Does this mean the tech industry is completely immune to interest rate changes? No, that is not true. If you look at Apple, the most liquid company in the world, biggest company in the United States, they do not rely very little. They rely on debt financing for new projects. They have usually enough retained earnings or cash in bank account to tackle new projects, innovate new technology, and thereon. So they could see problems on the consumer side. Most people that have an iPhone X or an expensive laptop usually have financed that laptop through their service provider, or they've got a loan for an expensive computer through a bank. So if interest rates go up and there's less available credit in the marketplace, consumers could see bigger interest payments on their loans on their phones and computers, or consumers could have a hard time buying the products outright to begin with. So this could affect Apple's sales, and Apple's just an example. It could affect the whole tech industry sales, as most of the tech products are very high dollar items and usually do require a payment plan of some kind. So if consumers have higher monthly payments, they might be less inclined to purchase new technology and would rather save their market. Because as interest rates increase, it becomes a saver's market. Right now, we are in an investment market. Money being invested is great right now. Once interest rates go up, it becomes a saver's market, and it's good for saving. So it's hard to say what will happen in the future, but it is safe to say the tech industry, time and time again, will outperform almost every other sector in the economy. And regardless of interest rates, Amazon is immune to interest rate changes in that regard, as well as a lot of other tech companies, just because they don't have much debt. They don't have debt, and they have the cash to outright buy their projects. The interest rate changes aren't quite as dramatic compared to commercial banking or financial sector stocks. Thank you very much for listening to my presentation, everybody. I hope you learned something from this. Thank you very much. Have a good day.